This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the American Monetary Association's podcast, where we explore how monetary policy impacts the real lives of real people and the action steps necessary to preserve wealth and enhance one's lifestyle.
It is my pleasure to welcome Harry Dent back to the show. He is the author of so many books. I started following his work back in the late 90s. Yes, it's been a long time. His most recent book, it's been a while since that's been published. It's called 0 Hour. We've had him on the show to talk about that in the past, but he's back with us again to share his latest thoughts on the economy. Harry, welcome back. How are you?
Nice to be back, Jason.
It's good to have you. You're coming to us from Puerto Rico again. And
Puerto Rico, I've been here for 8 years and never regretted it. Been coming here since 93. I had a vacation property on Culebra for many, many years and finally built a house there, which is far more difficult than I anticipated. But I finally moved down here when I watched San Juan grow from a second world city into a first world city. Then I said, okay, now I can just move down here because it's far better weather than Florida. Less cold in the winter, and we're at least 6 degrees less extreme hot in the summer, and that's where Florida gets tough. Is in August, September.
Oh yeah, no question about it. Well, Harry, there's a lot going on with the economy. We've got this crazy political climate too. Tell us just your macro view of things. You have been talking about a bubble for a long, long time, and so far the bubble has not popped yet. But what's happening?
Well, first of all, I mean, and this has never happened. This is not a long bubble. This is by far 3x the longest bubble before this. In other words, this has never happened before. And the reason is every bubble in history has come in good times, like the early 1900s, which turned in the roaring 20s. You know, when things get good long enough, investors and analysts and stuff just get all giddy and think, well, this is gonna, we've reached, as Irving Fisher said in 1929, the head economist there, a permanent plateau of prosperity, you know, and people start thinking that way. And that's when stocks get overvalued and then they bubble and they crash. And then you end up in a Great Depression when all these financial assets go down and wealth is destroyed and, you know, businesses laying out, you know, all that sort of stuff.
So you're saying, unlike Irving Fisher, you are saying we have not reached a permanent plateau of prosperity.
well, we didn't back then, but this looks more so because this has been the longest stock market run. I take out COVID because that was totally exterior and stuff. That just came and went. We were right back at new highs. 15-year boom without a real normal recession. That has also never happened in over 200 years of the stock market's existence. So the reason for that is very simple. It was only in 2008-9 when Ben Bernanke was the Fed chairman, who studied the Great Depression in the 30s as his thesis. When he saw 2008 hit, he was thinking like me. And I was telling people, we were predicting before and after, 2008 is 1930. This is the beginning of a Great Depression, a major bubble in financial assets burst, and a demographic surge in spending peaks and turns down and slows for a long period of time. And then you have a big deflationary deleveraging of debt, detoxing of debt, and asset prices come down. And that's the difference between a long or deep recession like in the 1970s or early 80s and a depression like the 1930s, or what should have happened, Jason, in 2008 to 2022, 23. Now, for the first time in history, again, you got to remember the Fed was only invented in 1914, had very limited powers, wasn't expected to do anything but just provide cushions in a short-term crisis, okay, to keep things from just going berserk. The Fed realized, well, we got the power to fight this damn thing. And Ben Bernanke, again, studied the Great Depression. He recognized it. Anybody else would have thought it was something different. He did see it. And he threw $1 trillion in the economy in 2009, thought that'd be enough. Okay, so did Mario Draghi over in Europe. No, not nearly enough, because it was a long-term crisis, and that's enough to get you through 1 year, not through 13, 14 years. So what happens? They had to keep upping the ante, printing more and more. And here we are, $27 trillion. Now, I'm the only guy that's counted this out and broadcasting it. 19 trillion of that is nonstop government, larger than average government deficits. I haven't had one surplus since 2001, okay? And $8 trillion of money injected directly, and that's what they call money printing. Well, spending deficits, because they just borrow these with treasury bonds and pay them back 30 years from now or something. All of these are creating money out of nothing and injecting it into the economy. So that's how we got the greatest bubble. Every bubble in history, again, has lasted 5-6 years most. Late 24 to 29, late 99 to early 2000. That was almost 5.5 years. That's a typical how long a stock market can go crazy by itself in normal conditions in good times before the bubble gets so crazy it bursts of its own craziness. And again, that always happens. This time we've gone 15 years, 3 times. So it's because of the government, the nonstop and accelerating government, and this time fiscal stimulus has been 2/3 of it, 70% I'd say, and the monetary has been 30. Now, what happened is they finally overreacted to COVID, okay, 20 to 22. They, out of that 27 trillion I'm talking about, 11 of it came in the 2 years after COVID, and that caused this 9.1% out of nowhere inflation spike. And again, I got the best inflation indicator in the world, bar none.
What is that? Wait. What is that best inflation?
It's workforce growth. It is the cost of incorporating new workers in the infrastructures and new technologies they bring and require early on in this, before they become productive and earn and spend all this money they're going to do. That inflation comes in the early stages when people are entering the workforce. People think that high growth causes inflation. Our best growth periods in history, from the roaring 20s to the 50s to the 90s, had low or falling inflation. So I knew that wasn't the case from the beginning. So my research, I kept digging, realized no, workforce growth, and that correlated with the biggest 70s inflation in history. And that said that inflation would come down to about 1 to 2% in the 80s and 90s and stay there for a long time. Okay. And that's what was happening. We had this high growth economy with low inflation. But when COVID came, 11 trillion in 2 years, well, that suddenly caused 1% inflation to turn into 9%. And when that happened, oh my God, we got a tightened monetary policy, 525 basis points, the biggest since the last inflationary crisis was peaking in 80, 81. And I mean, that was the biggest ever, but it wasn't just the 525 basis points. They had run the balance sheet from 1 trillion up to almost 9 trillion. That's $8 trillion of money also poured in with these.
Harry, wait a sec. I just want to establish a few things here before we go. You're providing a whole bunch of information like a fire hose here. So first off, you said a moment ago, we were talking about the bubble. You talked about how the Great Depression happened in the 30s and, the Great Financial Crisis, 2008, et cetera.
After a bubble in financial assets, after the roaring 20s bubble.
So I just want to make sure the listeners understand, where do you think we are? Clearly, you think we're in a bubble, right? Correct me if I'm wrong. But
we're in an extended bubble. The natural bubble would have peaked already.
Right.
In 2021 was when the natural bubble would have peaked, and now it's extended even 3 more years out, greater. Because the government keeps fighting it bursting.
Sure.
Ben Bernanke.
Okay, wait. Hang on. Hang on a second here. So define.
Do you want me to bring in Mr. Rogers? I can do that.
Yeah. No, I just want you to define, what does that mean to people? We're in a bubble. The impression is the bubble's going to pop. And when the bubble pops, what happens? Asset prices fall?
Bubbles refer not to the economy as much, but to the financial assets, the stocks and the real estate that reflect the bubble. In a bubble, these things usually go up, but they go up in a measured way commensurate with the economy and earnings. A bubble happens when the economy goes up long enough and people feel good enough about it, and it keeps going up a little better, that people start saying, oh, well, this will go forever. And so now that's when they start bidding up the assets more and raising the valuations. If you never thought there'd ever be a recession or depression again, any asset you're investing in would be worth more today, because that's the biggest thing that destroys value down the road. So people get giddy in a boom, and that's what happened in the Roaring 20s. It didn't happen as much in the 1950s, but it happened big time in the 1990s. We had a tech bubble, the first tech bubble, and that was the first real stock bubble, and very similar to 24 to 29. That was the first one since the Roaring 20s. Bubbles are rare, okay? But now we've had two stock bubbles and two real estate bubbles, the first one on the lag, and now both together. So this is double bubble, Jason.
Okay.
Which is very dangerous.
Can you provide any opinions on timeframes for us of when this bubble will pop and what that's going to mean to people? Like, what will happen when it pops?
Okay. The time for it to pop really is in the current time frame, only because, I mean, you got to remember, this would have popped a long time ago. Government keeps stimulating, keeps upping the stimulus. Again, this 27 trillion. If anybody, any economist or any forecaster in the early to mid 90s had told you that we're going to have a big slowdown and governments are going to print, the US government would print $27 trillion out of thin air to fight it, people would have thought, oh, that'll never happen. Okay. That's how crazy this is. Okay, so a bubble happens when financial assets start to go up much faster than the economy would warrant, because they're just thinking it's going to get better and better, and we've reached this permanent plateau of prosperity that Irving Fisher quoted in 1929. He quoted that right as the stock market was about to peak. Okay, that's what asset prices and the economy being good. People get delusional when they don't get their ASS kicked. Okay, once in a while. So and then you get a crash and you get a deflation to bring things, asset prices back down to reality. And that's painful when people are losing that much money. Banks are failing. They lend against all those houses and buildings. People lose money in their stock portfolios, and then they spend less money. Oh my gosh, I got to work. So it causes this whole tumble down effect where one thing just makes the other worse.
Got it. Okay, so time frames, any opinions on time frames as to when the bubble will pop?
The worst bubble and downturn took 34 months from the top of the stock market to the bottom to crash. 89% unemployment went to 25% on a lag to that. That was the worst downturn, and that's as long as it took. So I'm saying if we're getting ready to peak here or soon, this downturn will take us probably into late 2026 to mid 2027. It's going to take at least 2 years. It may happen a little faster this time because it's been stretched so hard. But
I want to distinguish. That's when the downturn ends or starts.
The downturn starts soon and it ends 2 to 3 years from now.
Okay, so it starts next year?
I'd say the stock market could have peaked in July here, by the way. Real estate will tend to peak on a bit of a lag. Things should be falling the strongest in 2025, if I'm correct. And then they'll continue to kind of staircase down into at least late 2026 and probably into early to mid 2027. It just depends on how fast it goes.
Yeah, let's talk about real estate for a minute, since I'm heavily attached to real estate. And I would like to see a little bit of a price adjustment so we could have a more normal market. But inventories are still very low. Yeah. They're about half of normal. And people have been calling for a real estate crash for quite a long time. And I've been disputing that. And everybody's told me I'm too optimistic. I have a vested interest. There's a conflict of interest. And, I've been right and everybody else has been wrong so far. Of course, things will change eventually. But you can't create more real estate supply very easily. There's a real...
Yeah, but the average person also can't pay $1 million for a damn TP, okay? It's getting there, Jason. But $400,000 for an average house in Ohio that was $100,000 just 20-some years ago.
I got it.
That's something somebody has to pay for, the interest and the mortgage.
Right.
For the same house. It'd be one thing for the same house.
Well, number one, you have to adjust that for inflation, of course, right? So the dollars are less valuable.
Inflation has probably doubled in this period, but overall this bubble's gone up 4x. Financial assets like real estate would have to come down 50% just to be in line with inflation.
But the problem is humans tend to just think, Harry, that because there's a trend line, you look at charts, right? That's one of your expertise, right? Just because there's a trend line in the chart, that things have to move back to the way it used to be. I believe that something could become permanently more expensive. And nothing's ever totally permanent
in every era than the one before, because more people, more infrastructures. And generally, the cost of living goes up. Partly, Jason, the real reason is we're always delegating more and more of the tax. I mean, the Little House on the Prairie, that guy, Michael, whatever his name, did everything.
Langdon.
You delegate and everything goes up, but you're specializing in what you do. So you may be making 3 times the income, but by delegating, everything may cost you twice as much. There's always inflation. Expanding new young people entering the workforce means you have to pay for those offices and infrastructures and training up front, and you get the benefit from that new worker getting more productive over decades. Okay, so inflation always will happen, and it happens mostly when new people are entering the workforce, and that's why the biggest entry of new workers in the workforce was from the late 60s into 1980, and that's when we had the highest inflation.
Okay, so back to the real estate thing, though. Look, housing affordability is the worst it's been in about 4 decades.
Yes.
It's terrible. Everyone would agree. But here's the reason that all the doomers got it wrong and I got it right. I think this is the fundamental reason. There's about 140 million housing units in the United States. When interest rates went up and prices were already elevated, housing became very unaffordable.
Yeah.
And the people that got it wrong viewed it this way. They viewed it as though, okay, a new entrant coming into the market to try and buy a house, it's very unaffordable for them. So that's naturally going to mean that demand will decline and prices will decline as demand goes down. But here's why they got it wrong. Because they didn't look at the tens of millions of people, about 130 million since rates went up, who control the existing inventory that don't want to sell because of their very, very cheap mortgages.
Right.
That have become an asset.
Not afford to get out of that mortgage. Yes.
Right. So because they control the inventory, it doesn't matter, even as demand has declined a bit, there's been demand destruction, prices have still gone up. I mean, supply side economics, right? It's the suppliers that mattered. There are tens and tens of millions of people that have very comfortable mortgages that ain't giving them up.
Jason, I'm going to stop you right there. Yeah. Okay. How do elections work? You know what decides elections? A tiny percentage of it, the swing vote.
Okay.
10, 20% at most. It's the same in economics too. Everybody can be doing everything normal and they're not going to change. It only takes 5% of people to just become all of a sudden net sellers or to get price out of the market. And then that starts it. And then the more prices go down, the more they go down. So that's the thing people don't miss. Yes, most people are not going to cause or trigger this crash. It doesn't take a lot of people, but people have to eventually sell these houses, whether they die or trade up to another one. And at some point, price alone will erase a bubble. And there's no bubble ever in history that has gone up forever and not crash. And no bubble that's gone up a lot hasn't crashed a lot. That's all I know. This may be the first one, Jason, and you and many people I talk to have theories of why this one will be permanent plateau. I'm telling you, I wouldn't bet 1 penny on a dollar on that scenario. Not even 1 cent for 10x returns.
I think it's pretty protected until one of two things happen.
Yeah, until something goes wrong. Exactly.
Well, hang on. No, not something go wrong. This is something goes right, actually. Until number one, we can create a lot more supply, or number two, we can create a lot less demand. Until those things happen, and real estate's very sticky, it's hard to create new supply of built real estate, right? Well, the one thing I always say, Harry, is that the one thing you must have, the one ingredient you got to have a real estate crash, is you have to have tens of millions of distressed homeowners that become millions of distressed home sellers. And right now we have the opposite of that. We have all these comfortable people that aren't in distress, right? I mean,
let me tell you something else that can cause a crash.
Yeah.
A crash happens somewhere else. Can you think of some little tiny little country over in Asia that has a real estate bubble that's already starting to fall
China.
apart? I've been preaching this forever.
Yeah.
That bubble makes ours look like peanuts.
Well, you're talking about Japan or China?
China. Well,
okay,
Japan's already. Japan's
gone through it for 3
crash when the
decades.
rest of the world didn't, just because they got overvalued and their demographics low. There was none of this stuff you're talking about here.
Yeah. So that's
real estate got extremely overvalued,
to your point,
and then their demographics.
Harry. To your point, you made me realize more than any other economist, because you study demographics. A major part of Japan's lost couple of decades was their demographic decline. They had a demographic problem.
Almost all that. But it also is preceded by a bubble. A bubble bursting makes any downturn.
But the U.S. has demographic growth.
Let me just get something straight here. 100%. When you see depressions in history, they follow major bubbles. When you see deep recessions, that just follows a boom. Recessions follow ordinary overexpansion of businesses and consumers and booms. It is depressions that follow bubbles because of the financial asset contraction that just makes it way worse.
Okay, so we'll agree to disagree.
And this is the biggest bubble in history, and it's the most global. End of story. Can anybody tell you, if you talk to anybody to tell you how much financial assets there are in the world now and how much there should be?
Yeah. Well, it depends how you count the derivatives, right?
630 trillion, it's 6 times GDP, and normal would be 2 times GDP at 200 trillion. In other words, we have about 3 minimum, 400 trillion overvaluation in financial assets, which cost everybody money. Now, if you can keep borrowing against that and they keep going up, yes, you can keep this thing going a long time, but at some point, you can't have a house cost so much that even a strong upper middle class person cannot afford it.
You know what I think happens, Harry? It's like this, and we'll talk about this chart that's on the screen in a moment, but I think what happens is this. And this is what economists don't see is people capitulate. They learn to accept less. This is what inflation does. It's insidious. It destroys people's standard of living. And so
people will buy a smaller house. That's one thing.
Yeah, absolutely. So it would be like this. Hang on. Let me finish my example. It would be like this. And you alluded to it because you talked about Puerto Rico versus Miami, right? And how overpriced Miami is. So it would be like this. It would be like someone moving from Memphis, Tennessee, or Nashville even, which is nicer than Memphis, to New York City, right? So they could have a big giant house in Memphis, and they move to New York City and they're living in a 1-bedroom condo.
Small condo.
In other words, they just learn to accept less as the standard of living goes down due to inflation. It's the same person, they're just accepting less. The standard of living has declined. That's what happens.
But the areas with lower cost real estate, like in the Southwest and Southeast, grow much faster. People don't just stay that way. Some people accept it, but more and more people don't accept it. And that's
I agree. And that's why we like those linear
out
markets.
Of California and the Northeast into the rest of the country.
Oh, I agree. Listen, that's why we invest in those markets, those nice linear cheap markets. Yeah, we like them. I agree. Hey,
and I'm in Puerto Rico. My house would be 3x in Miami here.
Yeah.
3x. Well, probably 4, but 3x minimum. Now,
and with the ability to do remote work, I mean, it's so easy to just live where you want.
Yeah, well, and 20 years ago, I didn't move here because San Juan wasn't a first world city yet. San Juan is a good city now. It's a first world city. I mean, it's not New York or San Francisco, but neither are a lot of cities in the U.S.
Hey, listen, New York and San Francisco aren't New York and San Francisco anymore either. Okay, they've become shitholes.
I couldn't even visit San Francisco now. It's so bad.
It's a disaster. It's terrible. Okay, look, you asked me to share this chart, and this chart for those on audio only, I just want to make sure you know what we're looking at. The chart is entitled "Bitcoin Declining Megaphone Should Reverse Sharply Down by 68,000. What is this chart telling us, Harry?
Okay, so Bitcoin, I focus on Bitcoin for one reason, that the whole, crypto sector, not just Bitcoin, it's set to restructure all the financial assets on a global basis, and Bitcoin will end up being the digital gold, but that's decades from now. But this is...
So you like Bitcoin? Are you pro or against?
It's a leader in the next... Most of these crypto coins will fail. It's not that, but crypto itself is one of the next big things, particularly in financial services. So this is real, and Bitcoin is in its baby bubble. I actually compare, Jason, Bitcoin to the leader in the dot-com bubble just 22 years before it, Amazon, and they're almost identical. Amazon went from $6 to 136 in the baby bubble, just like, Bitcoin just went from nothing to 73,000, and then it crashed all the way back to $6, okay, in the 2002 tech bubble crash. So that first bubble was the first tech bubble. We just saw the second tech bubble, and this is part of a 45-year cycle I track, every 22 years, 22 and a half approximately. So there's some method to this matter. And that bubble is bursting. The difference, Jason, is the government is extending this bubble and won't let it burst because they know Ben Bernanke started in 2008. He got so aggressive. He knows that when a bubble bursts, you get a depression, not a recession. And no politician, no Federal Reserve chairman wants to be in power
I agree.
when that happens.
I agree. And this, by the way, is one of the things I think a lot of the sort of Peter Schiff types miss. I mean, look, as much as we might philosophically disagree with it, I don't want to live in a centrally planned economy. I think the free market should run the economy. I don't really believe we should have a powerful central bank. I think it should be a minimalist central bank.
I agree.
But we have what we have. And the fact is, they don't want to see the economy crash either. So they're going to step in and do their thing, and that's what's going to happen. And a lot of economists just don't account for that. They just think that it's just math, that the market will just work on supply and demand and all that stuff, as it should. But that's not what we have. We have a centrally planned.
The market happily accepts all these new financial assets that have been created out of nothing, pouring more, all this money they poured in the economy. $27 trillion, by the way, I quoted that earlier, never happened before, 9% of GDP on average yearly. That money has gone into financial assets, has inflated this bubble. That's what's happened. So this bubble at some point has to burst. The trillion-dollar question that you keep asking is when. I think now only because they went into such extremes in bailing out COVID that they created that 9% sudden inflation, and they had to tighten hard, and they did, and we have not felt that yet. We're going to feel that first quarter the first quarter of next year. So about 6 months from now, that's when I'll be able to look at my newsletter subscribers and say, I think it's going to be much harder than people think by then, but here's how much the tightening hit, because they went straight from stimulus to tightening. That's never happened in history before either. So the stimulus hasn't even worn off and they're tightening. So that, we're really going to get the truth in the next 6 months is what I'm telling investors. I just warn people, be safe here. Stocks may look like they're going to keep going up. They could go down anytime. The first crash out of every bubble in history has been 40%, typically in a matter of 6 months or less, okay? So this thing could happen so hard that by the time you realize it's a crash and not a correction, you're already too far into it. I say this good time to be out of stocks generally, out of real estate you don't really need, especially speculative real estate, and see if this thing sets in, because I think it's going to set in. I think 2025 is going to be the worst year we see in our lifetime.
Okay, so I just want to get clear. This chart on the Bitcoin, what's going to happen to the price of Bitcoin?
Bitcoin is what I call the lead dog. Okay. It is the lead dog of the crypto pack, and kind of like Amazon was the lead dog for the dot-com bubble, okay? So, and I compare Bitcoin, and like I said earlier, directly with Amazon. So I'm looking at the Bitcoin bubble hit 73, peaked there. It's been going sideways because no bubble and everything's saying the bubble's not going to burst. Nobody wants it to burst. It's been going sideways, but in a downward thing. It's been having lower highs and even lower lows. That's what this chart is. It's called a declining megaphone. Megaphone is when it goes like this, not a channel is straight, parallel, a triangle is converging. This is a megaphone pattern pointing downward. We're going to get resistance if Bitcoin keeps going up. It's at 65.5 today. It's going to get resistance at 68,000. If it even makes it there, the final wave up usually does not go all the way up because it would make it too obvious. And if it goes down, we could see a sharp move in a short period of time down to the bottom of this channel, megaphone, about 40 to 42,000. And if it breaks that, we're back to the 15,600 lows, okay? in Bitcoin back in 22 or whatever, the last
Okay,
major.
so your prediction is Bitcoin is going to drop to 40,000.
And Bitcoin leads everything else. Crypto goes down, stocks will follow that, and they have generally followed on 3 to. So I mean, Bitcoin
what's your
peaked in
S&P
March.
number?
Stocks peaked in July. That's a 4-month lag that stocks are following Bitcoin already.
Okay, so you think stocks are going down, and what's going to happen?
But I'm looking at Bitcoin because Bitcoin will tell you when to expect stocks to go down. It's very hard to predict this. Stocks don't want to go. Nothing wants to go down. Nobody wants this bubble to burst, let alone the government and the Federal Reserve. Okay, as we've already discussed. So markets have to get bad enough on their own to start to trigger fear with investors, and then they start thinking differently. They start thinking, oh, they can crash. Sort of thing. So you have to get some momentum. So if we're going to see this, Jason, Bitcoin's going to lead this trend, and that's why
we got it on the Bitcoin. Okay, so I got it. So S&P is just over 5,700 right now. Yeah. Where's that going?
Well, it's got to go down about 40% just to get back down to the late 22 lows.
Ouch! Oh my God.
Yeah, I mean, that's when you realize
that's going to be painful.
How big a bubble is. When I say, wait a minute, a 40% crash is just going back a year and a half. Yeah. Whoa, that means you had a really big bubble to go that much to have to crash that much.
Okay,
so Bitcoin, that's why I'm saying you got to be cautious here, because when this happened, it's going to come fast. The 22 crash came fast. This will come even faster than that. Okay.
So Bitcoin is going.
But if Bitcoin starts to go, that gives you a little warning for stocks. So if it starts to get more serious, again, you see this pattern playing out, then yes, then you can get more serious about selling your stocks and so on. So you don't have to leave the bubble too early.
All right. So what I'm saying is Bitcoin is going to go down by a little more than a third. That's your prediction, right?
That's over 40% just to drop to 40.
Oh, sorry, 40.
I think that's 46% just to get to the bottom line there.
Hang on, I just want to get clear on a couple things. So Bitcoin's going to go down by 46%. S&P is going to go down by about 40%. What about gold? What about precious metals?
Gold is in its final bubble. Gold last time bubbled up with everything else. All the gold bugs say, gold's going to be the savior in the downturn. No, gold ended up going down in 2008, not as much as stocks, but it went down in the end. And this time, gold has bubbled up way more. And so gold, I'm predicting gold will peak here around 2,800, wherever it does. And when things crash on a lag, gold will end up, its support is around 1,100. That's a big crashing. That's maybe a 50, 60% crash in gold. And people think gold is going to be the safe haven. It won't be the worst place to be. But I'm telling you, in 2008 proved this, in the end, it will not be the safe haven. Treasury bonds are the safest thing on earth, despite our massive deficits, because everybody has bigger deficits than we do, and we're still the lead dog.
And, it's fair to ask, what will the value of cash be? What will the value of treasuries be vis-a-vis inflation? I mean, you've been pretty much a deflation guy for quite a while.
Yeah. First of all, there's very little inflation now. In my scenario, inflation will be 0 to negative. It was 0.4%. in the last crash, in 2009. So inflation is not an issue. Treasury bonds are the safe haven. They went up 45% when gold and stocks and real estate and everything else went down, and commodities and stuff. Treasury bonds were the one thing that went up 45% in 2008. And then there was time to sell them because that was just a safe haven play. I mean, who wants a 2, 3, 4% yield long term,
Okay, but I just want to be clear. So Harry Dent is not worried about inflation.
No.
Right?
I am not. They could blow $5 trillion in the economy and you might get a quick blip like we got 9%. That 9% blow, that came with COVID, that would have been over in a year if they hadn't done anything.
So in other words, you're saying it's going to be either flat or a little bit of deflation, right? Yeah. That's your prediction?
Yeah. Only two scenarios I have in a slowdown. We have to have a slowdown first. So that's the first thing I'm looking for. Bitcoin to start crashing, stocks to follow. Stocks going down alone will make people a little more bearish, and then the economy to start to slow. And then it all bubbles once they don't have to get going too much. They're so overvalued, the momentum gets very fast.
Okay. Let's talk politics for a minute if we can. I'm sure you have some opinions on this crazy political environment we're in. What do you think? And does your strategy change depending on the election?
No, it really doesn't. Most people don't get to do even a fraction of what they said they're going to do because of the split Congress involved. Yeah. It takes forever to pass. People acting like suddenly Kamala's going to get thing and do all these things, or Trump is going to cut all this by 80%. Not going to happen. So no, and it never does. What I would be good, Jason, is talking to people like running for president and tell them when to run or not. Okay, this isn't an election to win, especially not for the incumbent. In other words, Trump would do better in this scenario if he wins and the economy crashes, as I'm saying, right as he's walking in office. There's no way you're going to blame somebody that just walked into office, okay? Franklin Delano Roosevelt didn't get blamed for the Great Depression. He walked in well into it. Ronald Reagan didn't get blamed for the early 80s recession. He walked into when it already just started in 1980, okay? So that's the person who gets favored. And then it only takes 2 to 3 years to turn around the worst downturn, i.e. the Great Depression. And so by the time re-election comes up, whoever does win this election, either one of them, will look good and probably get reelected, but particularly if it's a new guy, Trump, that comes in. Now, Trump cannot run again. Now, Kamala is kind of in the middle. She's not Joe Biden, but she was her vice president, so she's a little more attached to the incumbent. If suddenly she walks into office and the economy goes down, well, people will blame Biden, which means indirectly they'll blame her to some degree. The problem is he's not responsible for this, okay? This bubble, the Federal Reserve and central banks have cranked up this bubble around the world. And Biden didn't tell them that they like them to crank it up during their term, but they're not in control of that. But people will still blame. So I would not want to be elected if I'm Kamala or Joe Biden got pushed out, but he's going to thank God he got pushed out, okay? He's the guy that would have looked the worst if he'd have won. And then while he's getting increasingly senile, the economy gets senile faster than him.
Yeah, interesting. Harry, you've done some interesting research on things like solar cycles and stuff like that. I'm curious, what is that and how does it affect us?
Yeah, the sunspot cycles are like 11 years on average. They vary some, and sometimes get a little longer or not, and you can track that. They affect business activity more. When the sunspot cycles are high, you're more likely to get higher value valuations. I'd say they affect to some degree, but they don't affect the economy like these. The two things I track: a 39-year approximate generation cycle, which I can measure exactly how many people are going to move into peak spending from a generation. And the technology cycle, you get two bubbles or booms and busts in a 45-year time frame, like the bubble into 2000 and the bubble into late 2021. Those were, 21 and a half years apart, right about that half of that 45-year cycle. So those are the two reliable cycles that I can predict and have the most direct impacts on the economy, way more. I look at any cycle, okay? And I like to study cycles in general, and I've studied more. So if I told people all the cycles I've studied, they'd think I was a nutcase, okay?
Yeah.
So I don't talk about all that. I don't want to confuse people. But I study other cycles because the more cycle you study, the more you get insights on what happens in each phase. Every cycle breaks into 4 seasons, just like our annual cycle and sort of stuff. So I have a whole wealth of knowledge on cycles, but these two cycles are the ones, and when you're in bubbles, that the bubbles always come from the 45-year innovation technology cycle. That's what bubbles up. It's the tech stocks that lead bubbles, not the Johnson and Johnsons.
I'm curious though, how do sunspots influence the economy? Like, why would they do that? What causes that?
Oh, that is a layup. More energy is falling on everything from plants grow faster. People feel more energy. People go out on this beach to soak up what? Energy. They're sitting there doing nothing, relaxing, soaking up energy. So it is literally more energy or less energy falling on everything on Earth. So that's an easy one for me. And I say it's an indirect. Doesn't mean people go out, oh gosh, I'm hot, so I'll buy a popsicle, although that happens. But but I can understand that. And it's not, this would be a bigger cycle I track. It's not anywhere near the impact of these other two cycles I'm talking.
Mm-hmm. Yeah, Very interesting. Harry, anything else you want to say as we wrap it up? Of course, give out your website where people can get your newsletter. Anything else you want to share?
Yeah. Here's the most important thing, and I hate to say this because the guy lives right down the road from me, okay, here in Puerto Rico. A lot of financial newsletter people are here in Puerto Rico because it's a great place and low taxes.
Yep.
Inflation is not going to be the outcome of this. It's impossible. An asset bubble, when it deflates, it takes money. This is money that's been created. Money comes out of thin air already, but financial assets blow that even more. When financial assets deflate, again, biggest number in the world is 630 trillion in financial assets, 6 times the GDP. That's what's going to happen here. This is not a normal downturn where businesses overexpand and they lay off workers and that causes more layoffs because it's, It'll be that. This is a whole nother dimension, and that's what was different from the 30s depression and the 70s long recession. So that's what you got to think. What you got to worry most about, your job second, you got to worry about your financial assets, real estate and the stocks and things like that you own. Anything that's financially valued has been blown up to at least double its value. Stocks more so, and real estate has to correct. I used to say 50%. Real estate's gotten the point to just get back to where it was before the bubble started. And that's in 2012, Jace, okay? That's at the last correction in real estate. That's not that far back. Stocks have to go to 2009 to get back to fair value. Real estate just has to go back to 2012. So you look at I tell anybody in this audience, look at your real estate. If you can determine what it was worth, let's say in the middle of 2012, give or take, that's your potential downside. Are you comfortable with that? If it's 20%, most people be comfortable with that. I'm telling you, it's probably going to be 40, 50, 60, 70%.
Oh my gosh. Wow.
That's
okay,
how
Harry,
much
I gotta ask you a question. Why does real estate have to go back to the 2012 price? Why?
If you study every bubble in history, and I actually, the chart in there, my thing, the first one, I think South Seas bubble was the first one, okay? Yep. It was like one individual stock. There was a
John Law, I know.
It went up from 1 to 99 and all the way back to where the bubble started at 1. Bubbles erase themselves and then start going back up and normal. In other words, they race more than they should because just as they go up more than it's worth, they also end up going down more than they should. So that's why bubbles are so treacherous.
I don't know why.
2009 is where bubbles would have to go to raise themselves for stock. That's when it started. And I look at 2012 for where real estate would have to go to erase its bubble. And that's and it can be different areas, but that allows you to look at different real estate. Real estate's much more varied than stock. There's a lot of real estate that won't go down that much.
Yeah. But I just don't understand why you're saying it has to.
You're gonna have to ask God on that one, Jason. I'm sorry.
Well, no, I know.
This is the law of nature. Things go up, they go down. Everything cycles. People say, Harry, why are there cycles? I don't know. Ask God. Everything goes in cycles. There's menstrual cycles. Okay, there's cycles in everything. There's mice cycles.
But let me talk for a second.
Sunspot cycles. Why do sunspots have cycles? I don't know. They do.
Okay. So here's the thing I'm pointing out is that how much coffee do you drink, by the way?
Three Nespressos in the morning, and those aren't a full. Those are about a 6/10 of a cup. So
wow, that's not much. Okay, you just have naturally a lot of.
Oh no, no, I don't need coffee. You get me on a stage, and
I know. I've seen you on stages many times. Okay, so but here's the thing, essentially you're saying, I mean, look, I don't know about the stocks. I'm not that versed in it, but the real estate I know, right? It's like looking at a chart. It has to go back to the trend line, the support level, which you're saying is 2012. Okay.
2012 for real estate.
Yeah. I know. But that doesn't take into account changing demographics, housing inventory.
Jason, all I do is look at history, and every bubble's the same, no matter where it came, no matter. I know what you're saying. People always say, but you know how many people coming after every president say, but Harry, my place, if you saw it, it's so special.
No, it's not about, I agree with you on that.
You know what goes down the most, Jason? The special real estate goes down the most. Why? Because it's so special, it bubbles the most.
I hate when people
All I
do
care
that.
is bubble up, bubble burst. I could look at any bubble and tell you where I think it's going and not have any idea what it was. It could be mice droppings. Okay. And if I see a bubble, I'll say, okay, well, this is probably going to go back to about here. I'm so sorry. I can do that.
Yeah. Oh,
bubbles are bubbles.
Yeah, right. Okay. It doesn't take into account changing population, changing
everything.
demographics.
You don't have bubbles in places that aren't growing already. You don't have bubbles in depressed places. You have bubbles in the new the new technologies are where the bubbles are. This is the new high growth stuff. So bubbles aren't random either. They come where there's very high growth, and human nature is to overreact to everything. We oversteer, overdo everything. Things get good long enough, we get overly positive about everything. Things go down long enough, people say life will never be the same, we'll never come back, blah, blah, blah. My kids will never, get good, people overreact. That's what we do. We just overreaction machine.
You talked about technology several times. Just before you go, I want to ask you some of these. Like, is AI a bubble? That's the big thing right now.
This
Everybody's talking about AI.
Early stage bubble. The crypto bubble is a bigger one. Crypto bubble, literally, when a speaker got up at my own conference and said it's about the digitization of all financial assets in the world, I'm like, I get it now. That's huge. 630 trillion. Even if you just 10% of that is huge if you can improve it. So that's when I got that this is a big thing. So AI is also a big thing, but Jason, I was talking about this in my Roaring 2000s book in 1998. I called it the automation of management and professional work. We automated farm work and then factory work. And then we've automated everything in the office, bookkeeping and all this stuff, automated computers, simple left brain stuff. Now we automate professional and manager. 80% of what lawyers and doctors and all these people and high-level managers do is automatable too, okay? Anything left brain is just more complex. But anything left brain, so now we automate that, and that brings a whole nother revolution because that's where the highest costs are. And the people, and more of us are getting higher education and becoming these professional and managerial people now that we've automated everything else. So we're always automating the present jobs, and that opens up people to move into new, higher human creative. We're going to have to do more and more creative right brain work because computers are left brain machines. Mm-hmm. Anything left brain can eventually put in a computer and be done at a fraction of a cost at the speed of light. That's what you're competing with, anything left brain.
Pretty amazing, no question about it. Harry, where do people find you and get your newsletter?
Okay, harrydent.com. That's simple. That site, we have hsdent.com to learn more about it, but you go to that site, that's how you just get on our free newsletter. All you do is push a button, put in your email, you're done, okay? And that right now if I should be listened to just as an alternative voice here, because anybody'd have to agree, this is not normal times. This is the greatest expansion, the most global, the most volatile things happening. You need to listen to alternative voices here.
Yeah, no, I
listen to me for free.
I get it.
One article a week and two rants. I'm going to talk to you twice a month for 5 to 10 minutes.
Yeah, you're definitely a ranter. I watch your rants. They're great. But, the thing is, the thing people never realize is, yes, you can say everything's a bubble, everything's overexpanded, et cetera, but the question nobody knows the answer to is how much longer can they keep kicking this can down the road?
Well, I tell you, Jason, the answer to me was a lot
Maybe they can print another 50 trillion and it won't even
matter. The answer was, for me, for a long time, a lot longer than I thought, but they did raise interest rates 525 basis points, and they cut that 9 trillion bloated balance sheet, 2 trillion almost, okay? That is big tightening, and that will take a year and a half to hit by past analysis, and that's why I'm not going to judge how much it's going to impact fully until the end of the first quarter of next year. And then I'll say, okay, now we know what we're dealing with, and I am expecting the economy to be significantly weaker by then. Stock market's always ahead of that. Bitcoin tends to be ahead of that, why I'm looking at Bitcoin now and Bitcoin peaking and dropping. So I want to be ahead of it, and I want my subscribers to be ahead of it. It's that simple.
And the way to get ahead of it is buy treasury bills. Buy T-bills.
I don't want treasury bills. I want treasury bonds, the longest duration, which is 30 years. Okay. Now, So if you're buying a treasury bond,
buy 30-year treasury bonds. That's Harry's
30-year,
advice.
because the longer the duration, the more the deflationary multiplier is going to happen for you. I'm saying that a 30-year bond will more than double if I'm right about this downturn being 50% deeper than the last one. They went
And
up
one of the reasons you're saying that is because we're going to have flat inflation or actual deflation, which makes the value of the bond
and
or
when you
cash
locked in
higher.
a 4% return for 30 years when it should be 1% over deflation or zero, how much is that bond worth?
Yeah. Okay.
Normally it would be impossible for a safe treasury bond to double. We already saw the 10-year bond go up 45%, not the 30. That was probably 65, 70. 10-year bond went up 45% in the 2008 crash in less than a year. That's what I'm looking at. This is your safe haven. Peter Schiff's going to tell you to go under. He's going to be right about this crash. He's going to be wrong about it sparking hyperinflation. It's only going to deflate when these financial assets do that. Nobody could print enough money to beat the financial deflation crash. I'm just telling you, almost impossible, or you'd look like an idiot and be shot, okay? So that means that the Treasury
I think they would have easily said that
gold.
Before the COVID era, and they just printed like crazy. But yeah.
The crash that deflated the last big bubble in history was 29 to 32, and that caused the deepest deflation and deepest unemployment and the biggest stock crash in all of modern history. And this one should be worse, if anything.
Wow.
The size of the bubble.
Yeah. Okay, folks, get your bunker ready. You better be prepared for this one.
I'm in Puerto Rico, man. We're not even going to catch this in the breeze. I'm telling you, we're a quarter of the way. People think we're south of Florida. We're a quarter of the way to Africa.
Yeah. Wow. Crazy. Okay. Well, Harry Dent, thank you for joining us. Everybody, you know where to get the newsletter, HS Dent or HarryDent.com.
HarryDent.com.
Yeah, good stuff. Harry Dent, thanks again.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.